Hi guys, today we are here to discuss the lesser known and lesser held investment instruments called REITs, which once gained popularity when they were newly launched in India, bit around COVID, and once again after their mention in the Hindenburg report. So let's dig deep into what exactly are REITs, understand their structure and compare their returns with the typical stock market returns, also understand how Indian REIT landscape looks like. As the name suggests, REIT is a trust which owns commercial income generating properties to the likes of, say, office parks, retail malls, data centers, warehouses, etc. They generate income by leasing out these properties to the tenants and hence collecting rental income from them. There are a lot of renowned properties in India which are held by REITs to the likes of, say, Downtown Powai in Mumbai, Embassy Tech Village in Bangalore, Nexus Select City Mall in Delhi. There is a REIT structure on the screen right now. REIT holds these real estate properties via these three SPV 1, 2, 3. These generate rental income by leasing out the properties hence owned by them. On your right hand side is a trustee who holds these assets for the benefit of the unit holders. On your left hand side is an investment manager who manages all these assets and receives investment management fee from REIT. There are unit holders who receive the cash inflow hence received by REIT as distribution per unit. As per the SEBI guideline, a REIT needs to compulsorily invest 90% of the assets held by them in properly completed real estate properties which are income generating in nature. Additionally, they also need to distribute compulsorily 90% of the cash flow hence generated by them as rental income to their unit holders. Hence, it's an absolutely perfect investment instrument for people or investors who want continuous cash flow in their bank accounts. India has 3 listed office REITs by the name of Embassy REIT, Mindspace Business Park REIT and Brookfield REIT. There's also recently one new retail REIT listed by the name of Nexus Select Trust. These REITs together manage assets worth more than 1.4 lakh crores in India and have distributed more than 18,000 odd crores to 2.4 lakh investors in the country. During COVID, there was a huge turnout of tenants from these properties and companies had a tough time getting back their full workforce, especially IT and IT enabled service sort of businesses, which are the biggest occupiers of such spaces, such properties, leading to downsizing and recalibration to a large extent of properties up until Q4 of FY24. Many tenants didn't even want to continue with SEZs due to the higher compliances and fewer tax benefits that were given to them. Embassy's occupancy rate fell from 95% to 83%, which has now gradually reached 85% in FY24. For the DPOs to improve, to grow along with the rent escalation, it is also very important for the occupancy rates to increase and also for the expansion of the portfolio, which can now be seen gradually happening with the REITs. DPO, which is distribution per unit for the unit holder, and price to NAV. These are two very important metrics which investors vouch for while evaluating any REIT that they are investing. Currently, the discount on REIT NAVs are in the range of 3 to 20%. The occupancy rates can be seen improving and simultaneously the interest rates are also very favorable. To add up onto this trend, the demand expansion of GCCs in India is expected to create an upsurge in demand of office spaces. Brookfield India REIT recorded the best performance till date in FY24 since their IPO in February 21, led by robust recovery in demand office spaces and growth in operating income. To further add to these points, REITs became a talking point when they were recently being highlighted in the Hindenburg report. It highlighted that Madhvi Puri's husband, Dhaval Bush, has been benefiting from the raft of regulations that were being implemented by SEBI in favor of REITs. Dhaval is a senior advisor to Blackstone, which is a sponsor and stakeholder of many REITs. Now let's compare the returns from REITs with the realty stocks. While the occupancy rate of many REITs have been increasing, giving a boost to their DPOs and the net operating income, it looks like Dalal Street is still stealing the show with their robust returns. While Nifty Realty Index has soared more than 90% in the past 1 year, there are a couple of realty stocks which have given returns to the north of say 200%. For example, Prestige Estate, Shobha Limited, to mention a few. Investors seeking an exposure to real estate are still favoring realty stocks or even thematic funds vis-a-vis REITs in today's scenario. Returns from REITs are a good combination of capital appreciation plus distribution per unit. Vis-a-vis that, returns from stock include a good component of capital appreciation and a very little component of dividend contribution. Hope this video was helpful for you. See you guys in the next video.